The Federal Reserve is constantly monitoring the economy and making decisions about interest rates in order to keep inflation at a healthy level. However, when the Fed raises interest rates, it impacts businesses and consumers in a number of ways. In this video, we'll discuss how the Fed's decision to raise interest rates can lead to higher levels of inflation. We'll also look at some of the factors that influence inflation and provide examples of how it affects people's everyday lives. Also, don't forget to subscribe to our channel and hit the bell icon to get the latest updates of our videos. But first of all, we will discuss what the interest rate is. An interest rate is the percentage of an outstanding loan that a borrower pays to a lender. The higher the interest rate, the more expensive it is to borrow money. In general, loans with higher interest rates have lower risks for lenders and are therefore more expensive. Conversely, lower risk loans tend to have lower interest rates. There are many different types of interest rates, but the two most common are fixed and variable. Fixed interest rates stay the same for the life of the loan, while variable interest rates can change over time. The Federal Reserve Board's target for the federal funds rate is one of the most important factors determining banks' prime lending rates. The base rate on corporate loans posted by at least 75% of all US banks. When the federal funds goes up, so does the prime rate. That also affects other rates, like credit card rates and adjustable rate mortgages. A change in the federal funds rate also can affect long-term interest rates such as those for corporate bonds and US Treasury securities. What do central banks do? Central banks are responsible for a nation's monetary policy and carry out this responsibility through several methods. The most common method is setting interest rates. Central banks use interest rates to influence a country's overall level of economic activity. When central banks raise interest rates, it becomes more expensive for businesses to borrow money, slowing economic growth. Conversely, when central bank lowers interest rates, it becomes cheaper for businesses to borrow money, which can spur economic growth. Another way that central banks influence a nation's economy is by buying and selling government bonds. When central banks buy government bonds, it injects money into the economy and can help boost economic activity. Similarly, when central banks sell government bonds, it removes money from the economy and can help slow down economic activity. Finally, central banks can also influence a nation's currency exchange rate. A low exchange rate can make a country's exports more competitive in international markets, while a high exchange rate can make a country's imports more affordable. Central banks use various methods to influence exchange rates, but one of the most common is currency intervention. This involves central banks buying and selling their own currency in order to influence its value. Why do central banks raise interest rates? There are a few different reasons why central banks may raise interest rates. One reason is to combat inflationary pressures. If prices are rising too quickly, it can be helpful to raise rates in order to cool down the economy. Another reason for raising rates may be to support a currency that is under pressure. Making it more expensive to borrow in that currency makes it less attractive for speculators and helps prop up its value. Finally, central banks may also raise rates simply because they think the economy is strong enough to handle higher borrowing costs. Whatever the reason, when central banks do raise interest rates, it usually has an impact on financial markets and the economy more broadly. Higher interest rates tend to lead to a stronger currency, higher bond yields, and increased borrowing costs for companies and consumers. This can all have an impact on economic growth and inflation. So when central banks make this decision, they are usually doing so with a lot of thought and consideration. How do raised interest rates affect consumers? The Federal Reserve recently raised interest rates, which has many consumers wondering how it will affect them. Here are a few things you should know. Your credit card payments will probably go up. If you have a variable rate credit card, your issuer can raise your rate at any time and for any reason. However, they must give you a 45 days notice. So if you've been carrying a balance on your credit cards, now is the time to pay it off or transfer it to a card with a lower interest rate. If you're thinking of buying a home, you may want to do it sooner rather than later. That's because mortgage rates are expected to rise along with interest rates. But don't let that rush you into a decision. Make sure you still shop around for the best deal. And finally, if you have any money saved up in a savings account, You may see your interest earnings go up. That's because most savings accounts are tied to the Fed's benchmark rate. So if that rate goes up, does the interest rate on your savings. But don't expect to get rich off your savings account. Even with higher interest rates, you're still only earning a fraction of a percent on your money. So there you have it, a few things to keep in mind as interest rates start to rise. Just remember to stay informed and make the right financial decisions for yourself. How do raised interest rates affect businesses? When the Federal Reserve raises interest rates, it's usually in response to inflation. The goal is to slow the economy and keep prices from rising too fast. But higher interest rates can also have an impact on businesses. For one thing, borrowing money for expansion or other investments can become more expensive. That's because when rate goes up, so do banks' charges for loans, and that can put a strain on profit margins. Higher interest rates can also make it harder for companies to service their debt. That's because the payments on things like bonds and loans go up along with rates. If a company is already struggling to make ends meet, this can push it over to the edge of bankruptcy. In general, higher interest rates tend to be bad news for businesses. But there are some companies that can benefit from the higher cost of borrowing. For example, banks and other financial institutions often improve when rates increase. That's because they can charge more for loans and make bigger profits on their investment. So, while higher interest rates can have a negative impact on businesses, it's not always all doom and gloom. It really depends on the type of business you're in, and in some cases, you might even be able to use higher rates to your advantage. What are the risks of raising interest rates? A few tricks come with raising interest rates, the most prominent being inflation. Inflation is when the prices of goods and services rise, and it can be caused by an increase in the money supply or higher demand for goods and services. If inflation goes unchecked, it can erode the purchasing power of money, which is why central banks try to keep inflation in check by setting interest rates. Another risk of raising interest rates is that it could lead to a decrease in economic growth. This is because higher interest rates make borrowing more expensive, which can lead to businesses slowing down their expansion plans or delaying new projects. Finally, rising interest rates could also cause a currency to appreciate, making exports more expensive and leading to a trade deficit. While there are risks associated with rising interest rates, central banks typically raise rates when the economy is strong enough to handle them. They will also take steps to mitigate any potential negative effects, such as by increasing the supply of money or providing more liquidity to the market. So, while there are risks involved, central banks usually have a good handle on managing them. Another concern that sometimes comes up is that raising interest rates could cause asset bubbles to form. This happens when prices for assets like stocks and real estate become inflated and people start buying them even though they're overpriced. This can lead to a decrease in demand for other assets, like bonds, and can eventually cause the bubble to burst. While this is a valid concern, it's important to remember that central banks can use other tools to prevent asset bubbles, such as by regulating the amount of money banks can lend. In the end, while there are risks associated with rising interest rates, central banks have a number of tools at their disposal to help manage those risks. So while you may see headlines about how rising interest rates could cause problems, it's probably important to remember that central banks are usually taking steps to prevent those problems from happening. How do interest rates affect inflation? Interest rates play a role in inflation because they affect how much money people have to spend. If interest rates are high, people will have less money to spend on goods and services, which can lead to deflation. On the other hand, if interest rates are low, people will have more money to spend, leading to inflation. So how do interest rates affect inflation? Well, it depends on the level of economic activity. If the economy is booming and there is a lot of money chasing after goods and services, then higher interest rates will be needed to slow things down and keep inflation in check. On the other hand, if the economy is weak and there is less money chasing after goods and services, then lower interest rates will be needed to stimulate spending and get inflation going again. In short, interest rates play a big role in controlling inflation. When prices start to rise too fast, the central bank can raise interest rates to cool things down. And when prices fall too fast, the central bank can cut interest rates to boost the economy. So there you have it. That's how interest rates affects inflation. Hence, the Fed interest rate hike does affect inflation. It's complicated and there are a lot of factors at play, but ultimately the Fed's actions impact prices. So if you're worried about inflation, it's important to stay informed and make sure you understand how these changes might affect your finances. Thanks for watching, and don't forget to like, share, and subscribe to our channel for more updates.